Hello all and welcome back. I hope you're all doing really well. Thank you again for the love and support on the most recent video. Let's jump straight into this one as there's lots of different news to cover from across the space, and we'll be looking closely at what might be happening next for the cryptocurrency markets. So on the Fear and Greed Index, we have fallen back into the fear zone of 30, quite a large drop from the yesterday's indicator at 41, which is also what we saw last week, which was approaching the neutral zone. So it looks like some of that relief rally enthusiasm is beginning to evaporate. However, we are still head and shoulders above where we were in June. So there is some optimism in the markets continually. Some interesting tweets here from Michael van der Pop. Bitcoin climbing upwards. Lows have been taken in the past 24 hours. Crucial to break is the 23.7k level back. If a move to 24k occurs, a flip of 23.7k is a trigger for longs to take their positions. The trend remains upwards on higher timeframes, and we're still expecting 28 to 30k in the next few weeks, according to this guy's piece of analysis. Now, of course, no one has a crystal ball, but some of the other metrics that go hand in hand with what we're seeing with Bitcoin at the moment is accumulation is still occurring. Wallets containing around 1 Bitcoin or so are at all-time highs, which means people have still been stacking Bitcoin. This indicates that they are in the belief that we won't see Bitcoin fall much lower, because, of course, if you believe Bitcoin was going to 10k, you wouldn't be buying Bitcoin in wheelbarrow falls. Now, we still have some bullish news as well for the Ethereum merge to take place in September, and we have had rallies from some of the altcoins, or meme coins I should say, like Doge and Shiba Inu that have taken place. However, it still makes sense to think that we will continue to trade sideways for the near future, and there is potential that we will experience a dip. Personally, I'm still averaging into positions, as I've said before, in this for the long term. I'd rather not try and time the market. Of course, there is nothing wrong with taking profits. If you are heavily in profit in some of your altcoins, maybe Quant or something similar, even Hbar if you were buying at the lows previously, it is well worth taking profit on those and then just averaging back in if the markets do go lower. However, I will not be selling large portions of my bags that I'll be holding for the long term. In terms of the market overview or outlook for the US economy, obviously the Fed meeting minutes have been published. So while not explicitly hinting at a particular pace of coming rate increases beginning with the September 20th to 21st meeting, the minutes released on Wednesday showed US central bank policymakers are committed to raising rates as high as necessary to tame inflation, even as they began to acknowledge more explicitly the risk they might go too far and curb economic activity too much. Participants agreed that there was little evidence to date that inflation pressures were subsiding, though some reduction in inflation, which has been running at a 4-decade high, might occur through improving global supply chains or drops in the price of fuel and other commodities. Much of the heavy lifting would have to be done by imposing such high borrowing costs on businesses and households that they would spend less, which is what the minute stated. Participants emphasized that a slowing in aggregate demand would play an important role in reducing inflationary pressures, yet despite that arc tone on inflation as their top concern, the minutes also flagged what will be an important dimension of the Fed's debate in coming months: when to slow down the pace of rate increases and how to know if the rate hikes have gone past the point needed to beat rising prices. So they're trying to strike a balance between increasing interest rates to curb inflation, but also preventing interest rate hikes getting too aggressive, which could send the US economy into a recession, which would then cause a cascade of issues for equity and cryptocurrencies alike. The futures markets are already beginning to price in these: a 53% chance of a 50 basis point hike, so 0.5%, and a 48% chance of a 75 basis point rise next month. So it's looking more likely that they'll be slightly less aggressive at a 50% basis or 0.5% increase to the interest rate. This is obviously slightly more bullish for the equities markets than a 75 basis point increase, but we'll have to see how this plays out. The Chinese economy as well has experienced a near complete collapse. Nearly 500,000 customers have lost their deposits as the banks lent indiscriminately to housing developers who are now facing cascading defaults. Here's the story the Chinese government doesn't want you to know. Now, of course, the Chinese economy has had a great run over the last sort of decade or couple of decades. And a lot of that is built up in the housing market. And obviously we had Evergrande default recently, which triggered a cascade of those property developers because real estate there is very, very lucrative. Several generations have to sort of come together in order to buy housing in those main city areas. All of this begins with one thing: real estate. Chinese are obsessed with real estate, and 70% of China's wealth is tied to real estate, twice as high as the US. Reports are now emerging about real estate Ponzi schemes, mortgage boycotts, and unfolding bank details. Chinese citizens prefer to invest in real estate as the Chinese stock market is notoriously opaque and unreliable. The Shanghai Composite, similar to the S&P 500, has not yet recovered from its 2008 peak, despite China's GDP growing nearly 3 times since then. For more context on how crazy the real estate market is in China, the median home price in New York is around 10 times the median annual income, but in Beijing, that could be as high as 25 times the median annual income. The insatiable demand led to Ponzi schemes where developers pre-sell homes which aren't even built yet and use the pre-sale money to start more projects and then collect more pre-sales from new projects. Buyers started a mortgage boycott as the properties have not yet been completed. The crisis spread to banks as they loaned out the depositors' money to developers who were now defaulting on payments. As frozen deposits mounted and protests erupted all over China, investigations revealed critical systemic issues. For starters, during COVID crisis, the government had lowered the 10% limit on assets that banks had to keep in cash, also known as a reserve ratio, some of which were taken over by criminal gangs who transferred the deposits outside of the country, with reports suggesting that over 400,000 customers have fallen victim to such activities. Public trust in banking systems have plummeted, and the government has stepped in to avoid bank runs and liquidity crunches, but their strategies seem at best questionable. The government has agreed to pay up $15,000 for lost deposits, but only if the banks weren't involved in the non-complaint transactions. So we can see here the Chinese economy at the moment is suffering massively, and it's similar to the US. Both of these are global superpowers. If one of these economies enters a massive recession, particularly because China is a massive net exporter to the globe, obviously a majority of the world's manufacturing is in some shape or form of the supply chain runs through China itself, we could see further economic pressure for economies as far-reaching as Europe or even the United States themselves. And again, this will then play on investors' minds, whether they take on risk or they defer risk to de-risk their portfolios. And obviously that's going to impact things like cryptocurrency, which is an inherently risky asset. So again, what we can see is that despite the US appears to be recovering from those high inflation rates, and there's a glimpse of hope at the moment, some other economies across the globe aren't fully yet recovered, and this has a domino/knock-on effect. Anyway, that's enough of where we are on the macroeconomic side. Let's take a look at some news across the crypto space for projects that we all are aware of. So HBARX update on NEARX security incident. So Stader Labs had an incident with their NEARX security for the staking protocol. So on August 16th, an exploit was found and used on Stader's liquid staking solution on the NEAR blockchain. The attack was quickly discovered and contained. The total value loss was limited to around 165,000 NEAR tokens, around $800,000. In this blog, we'll take a deeper look at the nature of the exploit, how it was specific to the NEAR blockchain, and why it won't affect HBAR or any of Stader's other liquid staking solutions. To understand the exploit, we need to understand an aspect particular to NEAR. Most blockchains have a token standard and reference implementation of that standard. HTS is in the case of HBAR. NEAR has prescribed token specifications for Net 141, but the implementation as per specifications was to be done by Stader itself. This is a regular process followed by each protocol on NEAR. So what happened? The token implementation for NEARX was where the bug was exploited. A specific edge case in the implementation of the token standard by Stader led to the bug that resulted in the exploit. The malicious actor was able to build up a large position in NEARX without staking or interacting with the staking contract. The attacker then went on to drain liquidity on the DEX pools. Our monitoring systems caught the issue and we paused the NEARX contract to limit the damage. It bears noting that our staking contract, which controls the workflows of staked funds, had no issues and staked NEAR remained and remains safe. The resolution being that Stader has announced that we will revert NEARX back to the pre-attack state and make the affected users whole by covering the 165,000 NEAR token losses. You can read the announcement here. So Stader is basically going to make all consumers whole by refunding the NEAR that was stolen. So why can this not happen on HBAR? Reference HTS token implementation. Hedera has a battle-tested reference implementation of HTS token that Stader and other protocols use. This implementation has been tested over millions of transactions across multiple protocols and thus very robust. The HBAR solution is on a different tech stack. None of the code for our NEAR solution, token or staking contract, is reused in HBARX implementation. NEAR is based on Rust, while Hedera is an EVM compatible chain. Additionally, our HBAR staking implementation has been stress tested across several months, 86,000+ transactions, 12,000 users. As a precaution, we continue to work with security experts to stress test all our contracts. So what we can see here is obviously Hedera has that additional level of security anyway via HTS over and above NEAR. And not only that, if there was a malicious actor that took advantage of the NEAR protocol and that could have been exploited on the other protocols Stader provides, they would have gone ahead and done that already, which they haven't because they can't. So the TLDR is that the NEAR protocol had an exploit which someone took advantage of. However, Hedera natively doesn't have a similar exploit like that. Therefore, the HBARX protocol is safe to use. I'm continuing to stake with Stader themselves up until the end of August, where I'll reevaluate what I'll be doing. And that's, of course, when we transition across to native staking. I may decide to provide liquidity or provide more liquidity on SAUCERSWAP in order to get some additional rewards over what the native staking yield rates will be. COINBASE CEO, Coinbase could shut down Ethereum staking under regulatory threat to preserve the network's integrity. So again, this goes back onto not your keys, not your crypto. There's not really much you can do if you're with a provider that will then bend to the regulatory pressure that they receive. It's always worth holding these in custodial wallets. If you then do wish to stake, when the transition from proof of work to proof of stake occurs, you are able to do so on a decentralized exchange, something similar to with a wallet, such as MetaMask, and then a platform like Uniswap or something similar for Ethereum staking. And the same can be said for all types of other cryptos. It's well worth holding those in non-custodial wallets. What we can also see is USDC has blacklisted several Ethereum accounts last week, freezing their token balances. But aren't token transfers permissionless? Here's how they did it. Tokens like USDC are simply numbers stored on an Ethereum token contract, very different from the physical tokens we imagine in our heads. These token contracts using the ERC20 standard contain parameters like token supply, inflation rates, and ownership balances. When you send a token to another wallet, the token isn't actually leaving your MetaMask wallet. Instead, your private key signs a transaction that calls the transfer function of a token smart contract, updating the ownership balances via debiting and crediting accounts. Your MetaMask wallet, something similar to Hashpack, looks like it contains these tokens, but that's not really the case. Your wallet has a private public key pair, and your MetaMask pings each Ethereum token contract to find ownership balances that match your public address. Because these tokens are contracts, you can add additional parameters. That's how USDC can blacklist addresses. Every time an account is about to make a transaction involving USDC, the USDC token smart contract checks a list of addresses to see if the sender or receiver is on the sanction list. If so, the transaction is blocked, freezing the balance of the listed account. You can check out a full episode as to why Tornado Cash was banned and USDC blacklisted on that YouTube link there if you look up the Empire Pod on Twitter. But what we can see here is that as we see more regulatory power come into the space, we may be seeing more and more things like this happen, not only in the Ethereum chain, but also other chains, potentially even places like Hedera. Now, of course, Hedera does stay on the right side of regulatory power and have always stood by that as something that they will continue to maintain, which is obviously very good for a massive layer 0 solution. Wanted to cover as well, BANXA official, you can now also sell your Hedera USDC, Circle Pay from within your Hashpack wallet. So you had the on-ramp of where you were able to buy USDC via BANXA, and unfortunately the fees were quite high as compared to like a centralized exchange. But you can also now sell your tokens via something like SAUCERSWAP to USDC, and then use the BANXA function to send the USDC from your Hashpack wallet to your bank or whatever it may be to basically take it off. So the on-ramp is now in place and the off-ramp is also in place as well, which is really great for the Hedera ecosystem. This brings more liquidity and attracts more sort of retail and institutions because the ecosystem is obviously fledging itself out in a much greater way. Something new that I wanted to bring to your attention is something called CITADEL Wallet. This is very new, very small amount of followers currently on Twitter. I believe 𝗟𝗚𝗡𝗦 is also affiliated with this project, may be built in conjunction. However, it's saying the most secure, user-friendly, and feature-rich hardware wallet ever built is coming to the Hedera ecosystem. It will soon support HBAR, HTS tokens and NFTs, native staking, smart contracts 2.0, HCS, scheduled transactions and more. 1,000 retweets and the website goes live. So no website just yet. Nothing as well about the security or how it's going to work. I'll try and get some more information on this because I know a lot of you guys obviously want to be able to use your ledger with the Hedera token service, which obviously isn't supported at the moment. I believe Decent supports some Hedera token service tokens, if I'm not mistaken. But on the whole at the moment, only HBAR really is supported by hardware wallets. So it'll be interesting to see how this develops. I'll keep you guys updated on that. The total number of Ethereum name service registrations, or ENS, has surpassed 2 million. And this again shows that we are seeing massive amounts of adoption in the Web 3.0 space. Don't forget, we've got Web23.io on Hedera that is building a Hedera name service, something similar to the Ethereum name service, where you'll be able to use it as a sort of proxy to go to Web 2 domains. And hopefully we'll be seeing that launching. They have been running an alpha at the moment, which looks to be working very successfully. Once I've got more information about Web23.io, I will of course relay it in a video, as I think that would be a very great addition to the Hedera ecosystem and something that many people are looking forward to. And it's great to see that that is still expanding on Ethereum, because Hedera is obviously a lot cheaper in terms of gas fees, and I'm sure the minting of those domains and the renewal fees of those domains will be much cheaper than the Ethereum name service. Finally, wanted to wrap up as well with some more crypto adoption. Australia seems to be coming along in leaps and bounds when it comes to crypto. Consumers can now pay for gasoline with crypto, as well as other services, at 175 OTR service stations across Australia. So that's right, you can now buy gasoline and diesel with cryptocurrency at, I guess, pay at the pump services over in Australia. And of course, we've got those rumors about a CBDC in Australia and potential ties to Hedera. We've got FPOS as well, which is obviously working with Hedera and using some of the services like Hashgraph in order to build out some of their infrastructure. So it does look very good indeed for cryptocurrency on that side of the world. Quick PSA as well from 𝗟𝗡𝗥𝗙𝗚s, and this is obviously not to do with 𝗟𝗡𝗥𝗙𝗚s, but to do with Discord, unfortunately. Scammers can name themselves in Discord to resemble other existing users. For example, John_1234 will look exactly like John_1234, but one of them will be malicious. Please only use secure trades or secondary market trades and stay diligent. And this follows on from many different users being scammed recently via Discord servers. Someone will message you saying, I can't use Zoo's marketplace and my secure trade doesn't work, which is complete bollocks. It does work. What they're trying to then do is say, we'll contact an admin that can basically be like a third-party arbiter or an escrow service. That person will come in looking like the real deal, but they're not. It's a fake account they've somehow manipulated, and then effectively you get scammed out of your NFT, you receive nothing in return, and then they completely disappear. So the best way to secure yourself against this is only use secure trade. If they say secure trade doesn't work, bin them off and block them. And if they then try and message you and say we're going to get other people involved, again, just block them straight away. It's most likely a scam and it's not worth taking the risk. We need to be very careful at the moment, as obviously this is getting rifer as crypto begins to expand. You also see Christian Hasker's response there. We need something better than Discord for our decentralized world. So maybe someone is working on that. Right. Rounding up the video then, 7,000 HBAR giveaway to celebrate SAUCERSWAP hitting 7,000 followers on Twitter. Follow SAUCERSWAP Labs, join their Discord, which you guys should already be a part of, as there's great things coming out of SAUCERSWAP. They're picking 2 winners for 3,500 HBAR each if you've retweeted, liked and tagged one friend, and the winners will be announced tomorrow, which is Friday, August the 19th, onwards and upwards. And of course, there's still harder work on their roadmap. Anyway, guys, hopefully you enjoyed this video. If you did, leave it a like, drop a comment, you got something to say. I'll try and respond to as many of them as I can, and I'll catch you in the next one. Cheers.